Welcome to This Explainer. Today, we're jumping right in and peeling back the layers of the market to reveal the raw, actual mechanics of trading. We're going deep into the source material to completely shatter some of those get-rich-quick illusions along the way. Listen, if you've ever looked at a price chart and wondered what on earth is actually happening behind all those red and green bars, well, you're in exactly the right place. Let's dive into it. We've got to start with a pretty harsh reality check. The source material points out that an overwhelming 99% of novice traders absolutely lose their money. And why is that? Well, it's mostly because they treat this incredibly complex market like it's a giant overnight lottery ticket. They jump in thinking it's an easy way out, usually guided by terrible advice on the internet, and because there's no regulatory body that's going to knock on your door and tell you to stop, they just keep making the exact same mistakes until their capital is completely wiped out. So, if you want to be part of that 1% who actually wins, it requires a massive mindset shift. As the source material emphasizes over and over, trading is a serious, hardcore skill. In fact, the creator notes that it took them upwards of 6 years to truly master it. It's all about patience, studying the raw mechanics, and actually putting in the screen time. It is absolutely not going to happen in a week. So here is our roadmap for today. We're going to cover the 99% reality, basic long and short trading, candlesticks and the imbalance of power, support, resistance, momentum, multiple timeframes, and finally, the infamous big player liquidity trap. Let's get right to it. All right, Section 1, trading basics, long and short. Now, buying low and selling high is pretty obvious, but how do you actually make money when the market is totally crashing? That brings us to short selling. Okay. Think about short selling like this. Imagine your buddy gets a brand new iPhone 16 Pro but wants to keep using their old phone for a year. Now, the price of electronics drops over time, right? So you borrow that brand new iPhone and immediately sell it in the market for 1 lakh. Fast forward a bit, and shocker, the price drops. You go back to the market, buy the exact same model brand new for 80,000 and hand it right back to your friend. Boom, you just pocketed a cool 20,000 in profit without ever originally owning the phone. In the financial markets, your broker is basically that friend, lending you the asset to sell first and buy back later. Moving on to Section 2, candlesticks and the imbalance of power. Now that we know how to profit in either direction, let's look at those green and red graphs and bust the biggest myth that completely wrecks that 99%. Our source material is crystal clear here. You have to stop blindly memorizing textbook chart patterns like double tops or bull flags. Seriously, the market is not a textbook. Instead, you've got to focus on what is called the imbalance of power. You need to look at the candle's wicks, those thin lines above and below the thick body, as literal footprints of price. They are the only things telling you who is actually winning the battle between the buyers and the sellers. There's a huge difference between the textbook view and the pro view. The textbook tells you that a red candle means sellers are in absolute control, but a pro, they look way deeper. Imagine a red candlestick with a massive wick at the bottom. Sure, the price closed slightly lower than it opened, so yeah, it's red. But that long lower wick means sellers tried to push the price all the way down, and buyers aggressively stepped in with enough power to shove it right back up. So the color is red, but the imbalance of power heavily favors the buyers. That is how you read what's actually happening. Which brings us to Section 3, support, resistance, and momentum. Zooming out from those individual candles, we can see how these localized battles create larger, distinct zones called support and resistance. You see, support levels aren't just magical coincidences on a chart. As our source explains, they form because of massive institutional players. Let's say a major bank wants to buy 100 kilograms of gold. They literally can't just click buy all at once, or their massive order would instantly drive the price so high they'd ruin their own trade. So maybe 50 kilograms execute first, pushing the price up. When the market naturally dips back down to that same zone, another 20 kilograms of their pending order triggers, bouncing the price right back up. Those unfilled, resting institutional orders are literally acting as a concrete floor. That's what retail traders are seeing when they draw a support line. But, and this is a really big but, just because a price bounces doesn't mean a big player is actually there. For a support level to be valid, you absolutely must confirm the move with strength, momentum, and ideally high volume. You want to see wide, full-bodied candles closing strongly away from that zone. This momentum is basically your lie detector. It proves that massive institutional capital is actively participating and is not just a weak, fake move that's going to collapse on you. All right, Section 4, multiple time frames. Because honestly, even if you can read the imbalance of power perfectly, doing it on the wrong time frame is just a fast track to losing your shirt. Novice traders absolutely love to stare at the 1 minute or 5 minute charts because, well, it feels fast and exciting. But the noise level on those is insanely high. They just get chopped to pieces by frequent fake moves. And while they're doing that, they are entirely missing the massive, undeniable trends that are unfolding on the 4-hour or daily timeframes. The big institutions dictate the large trends. As the source says, the trend is your friend. You've got to do multiple time frame analysis. Start with the daily or 4-hour to find the true direction, and only zoom in once you actually know which way the heavy institutional money is flowing. And that leads us to our final part, Section 5, liquidity, the big player trap. This is the deepest layer of the onion, guys, where smart money actually uses retail textbook knowledge as a literal trap. Just think about this for a second. Have you ever put your stop loss exactly where the textbook told you, right under a perfectly obvious support line? And then, infuriatingly, the market dips just enough to hit your stop loss, kicks you out of the trade, and then immediately reverses and shoots straight up to your target? Yeah, you aren't crazy. That is completely by design. Let's break down exactly how this trap works. Retail traders are incredibly predictable. They put their stop losses just below obvious support levels. Now remember the basic mechanics. If you bought an asset, your stop loss is mathematically a sell order. Big institutions need thousands of sell orders to fulfill their giant buy orders without causing slippage. Since there aren't enough natural sellers hanging around, these institutions will intentionally push the price down to engineer a fake breakdown. It's called a liquidity sweep. They are deliberately triggering all those retail stop losses. The second the retail crowd panics and their automated sell orders flood the market, the institution scoops up all that juicy liquidity, fills their massive buy orders at a discount, and rockets the market upward. And look, this is exactly why the source emphasizes that risk management is quite literally your only armor. Even if you completely understand liquidity sweeps and the imbalance of power, the market is perfectly imperfect. You are going to get trapped sometimes. If you don't master your position sizing and stick to strict risk-to-reward ratios, none of this advanced knowledge is going to protect your capital in the long run. So, wrapping up this explainer, you've really got to ask yourself a hard question based on everything we've just uncovered. Are you going to keep falling for those textbook illusions and placing your stops exactly where the big players want them? Or are you finally ready to read the true imbalance of power and analyze the market like the 1%? The choice is entirely up to you.